8 out of every 10 investors that I have met had a very common way of investing their money. When I asked them why did they choose a particular mutual fund or why did they invest in a particular stock, the answer was that they went on to some of the very commonly referred to research websites, found the funds which have given the highest returns in the last 3 or 5 years and pick those funds for making an investment. Well, it may seem logical that you pick up funds which have given the highest returns and then put your money in those funds. What if I told you that this was a short way for you not to make money in investing in such funds? Surprise, right? Hi, my name is Harshvardhan Dawar and I'm from Wealth Cafe, where we share with you ideas to help you make smart investing decisions. Well, it is a very common trend, again thanks to information being available so easily and being so accessible to everyone, that whenever you want to invest your money whenever you have the extra money to invest, you go and look up the top rated fund, find the fund which has given the maximum returns in the last 3-5 years or 2 years or 1 year maybe, and invest your money in that particular fund and expect that performance to be replicated. Let me ask you a question. If you're a tennis fan, you know that Roger Federer is somebody who is one of the best players ever to have played, and he is somebody who is a grass court specialist, who is someone who plays really well on grass court. Whereas if you pick somebody like Rafael Nadal, he is very good in clay court. He's a clay court specialist. And if you are somebody who understands the game of tennis, if there is a match happening in Wimbledon on the grass court between Federer and Nadal, both of them are fantastic players. On any given day, you will struggle to choose between whom you should back, who's going to do better on a particular day. They both are extremely talented. But if both of them are playing on a particular day on a grass court, say in Wimbledon, if you are somebody who follows tennis, you would back Roger Federer to do better because his game is such that he is better off on a grass court, versus if it was the finals of the French Open, you would back Rafael Nadal to do better because he is a natural player on a clay court and that is his strength. That is the strength of him as a player versus Roger Federer. Having said that, it does not mean that they have not beaten each other at the other's backyard. Obviously, Roger Federer has won a French Open defeating Nadal. Nadal has won a Wimbledon defeating Roger Federer. But those are exceptions rather than the norms. More often than not, it is Roger Federer who's done better on a grass court and it is Rafael Nadal who's done better on a clay court. The reason being, those particular courts suit the players, suit their style of playing and suit their strengths of how they play. The same logic, the same fundamental applies to when you invest in mutual funds. When you invest in different kinds of mutual funds, every fund manager has a style of investing. The popularly known ones are the growth style of investing or the value style of investing. There is something also known as the momentum style of investing. Whatever be the style, everybody has a certain style of investing. And there is no fund manager, irrespective of however far you go in history, however wide you go in terms of geography of fund managers, there is no fund manager who has managed to do well in every kind of market cycle. Depending on your style of investing, you will do well in certain market cycles and you will not do well in certain market cycles. That is the reason why investing in the top returning mutual fund is a very bad idea. If somebody has done well in a certain market cycle, he has given fantastic returns, and today when you look up the internet and you find that okay, this has been the top rated fund of the last 1 year or 2 years, that means that that particular fund manager's investing style has already played out and given fantastic returns. There is a very little statistical chance that he will actually be able to repeat his performance in the next year, next 2 years or next 3 years, because the market conditions are going to change and his investing style will not return purely for statistical reasons. It will not give you the best returns even in the next 2 or 3 years. If you go back and look at the top return mutual funds of the last 5, 10, 15 years, you will find that there is not a single fund which is consistently the best returns or consistently in top 3, consistently in top 5. There is not a single fund which is consistently every year giving you the best returns of that year. The reason being, Every fund manager has a different style of investing, and certain styles do well in certain market conditions and certain styles will do well in different market conditions. No style will do well in every market condition. That is why when you invest in a fund which has already given its performance, right? It's like your Roger Federer has just won the Wimbledon and tomorrow he has a match with Rafael Nadal on a clay court in the French Open. You would back Nadal to do well. Although Federer is a fantastic player, you would still be lopsided towards him purely because that suits his game, right? That is why when you are investing in a fund which has already done really well in the last 1 or 2 years, expecting that fund to replicate that performance in the next 1, 2 or 3 years is going to be a difficult choice. It can happen that over a long period of time, it will give you a good return. There is no doubt about it. But investing in a fund based on its performance in the last 1, 2, 3 years and expecting that to get replicated in the next 1, 2 or 3 years is something that's not going to happen. And this was actually proven in a study which was done in the US on the mutual funds market, where it showed that investor was worse off by investing in always the top return fund in a particular year, because those returns or the performance never got replicated in the next year. And that is why you as an investor generally tend to pick the top return fund, invest in it, and you don't get the same return in the next 1 year, 2 year, you're disappointed, you take the money out and then go out looking for again the next top rated fund. So that is why it is important that you stop doing this. I hope I busted this myth of the fact that you can invest in the top return fund and replicate that for your portfolio. Instead, choose funds based on your goals, based on your requirements, based on your tenure. And if you are somebody who is not apt at doing it, there's nothing wrong in consulting a financial advisor who will help you make the choice of the right funds that are suited for you rather than the top rated funds of a particular year. If you have any questions, please leave them in the comment section below, and do like, share and subscribe our channel, and continue to receive such fantastic investing ideas every Wednesday and Saturday.